Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with DJ Tierney, who's the Director and Senior Investment Portfolio Strategist at Schwab Asset Management. DJ, thanks so much for joining me.
Oh, thank you for having me, Sumit. Great to see you.
Absolutely. So, DJ, you recently launched an ETF called the Schwab Ultra-Short Income ETF, and it has the ticker symbol SCUS. And apparently, this is your first actively managed fixed income ETF. Why did you decide to launch this product now?
Well, Sumit, it's part of a longer-term plan. You may know that over the last few years, we've been steadily increasing the number of bond ETFs we offer. Last year, we brought our first high-yield bond ETF to market. The year before that, a municipal bond ETF. And so, we're just continuing to build out choices so our clients have options in terms of how they invest their fixed income money.
So DJ, I'd love to get your take on how this ETF compares to, say, a money market fund. Obviously, a lot of investors have piled into money market funds over the past year or two. I think there's over $6 trillion of assets over there. How is this ETF different than those?
Well, great question. And so I'll state really clearly, this is not a money market fund. And so this is different. Money market funds have pretty strict regulatory rules around them. They tend to be really, really short in duration. This is a longer duration front end of the yield curve investment. And so our portfolio management team will have the option to go out as far as 1 year in duration. So it won't have a net asset value that is set. It'll have a price that will fluctuate with front end interest rates. But giving our portfolio managers that latitude gives investors the choice to move a little further out the front end of the curve and really deliver what we hope is an optimal blend of income and yet capital preservation.
How does the yield on this ETF compare to a money market fund?
Well, right now, as you may know, we're in a unique circumstance where the front end of the yield curve is actually inverted. And so the overnight rate, the Fed funds rate, really was a good proxy for where money market funds tend to invest, is the highest point of the front end of the curve. And it steadily declines 3 months lower, 6 months lower, 1 year lower. So as you would expect, if a fund has the ability to go out 6 months to a year, the yields on this at this moment in time will actually be a little bit lower than money funds. However, in the future, that might change, right? As the Fed begins to cut the front end rates, we may see a change in the shape of that curve. And so we'll have a choice for investors to consider to move out inside of that 1 year time frame.
DJ, I have to ask you about the Fed because this video is posting on September 18th, right before the Fed is set to make its latest monetary policy decision, and everyone is expecting the Fed to cut rates. Do you think by embarking on this potential cutting cycle, things are changing for the fixed income market? Because for the past year or two, all investors had to do is go into money market funds and ultra short-term bond ETFs and not really worry about taking on interest rate risk. Do things change now?
I believe they do. We are, along with the market, expecting a cut in the Fed funds rate at this September FOMC meeting, but we'll see. I mean, nobody really knows the pace in which they'll cut rates. But if you look at the dot plot and market expectations, as you referred, in 1 year from now, we could see a dramatically lower front end rate. And so we do, just as investors took comfort in that 5+% yield they've been getting, when that yield drops, it may spur them to take another look. And we would endorse that. It's probably a great time to meet with your advisor and talk about your fixed income allocation and what is the right blend for you for getting yield and income and yet managing your interest rate exposure. So I do think this will be a change. We didn't, bring this product to market because of this current Fed environment, but it will give our investors a choice to move out a little further on the curve.
Finally, DJ, as we mentioned, this is your first actively managed fixed income ETF. Can we expect that Schwab is going to launch other active ETFs in the future?
Well, I can't talk too specifically about our future plans, but I will say, we're always looking at the market and looking at choices that we could, funds that we could bring. And if we determine that an actively managed bond fund could be an advantage and benefit our clients, it's certainly something we'll consider.
Fantastic. Well, a ton of great information, DJ. Thanks so much for your time.
My pleasure. Great to see you today.